Okay, good evening, everybody. Is my screen, are you able to see my screen, Ethan?
Yes, we can, but I think it's not in the slideshow
Yeah, I'm
mode
just,
yet.
correct. I'm just, absolutely, okay.
Okay.
Okay, fantastic. Thank you, Ethan. Thank you for the kind introduction. And again, very good evening, everybody. Nice to see you all. So as Ethan
Sorry,
mentioned, I
sorry
was
to interrupt,
part of,
Manish. Maybe you can change the display setting to the non-presenter mode.
oh, yes, sorry, yes.
Yeah, and just a quick reminder for those who didn't manage to locate the question box, we have a very short Q&A towards the end. So I encourage all of you to find the question box, and maybe you can ask Manish, our expert here, if you have any questions. Just type in the box, it's anonymous anyway. So any questions today, just type it in and we'll try our best to answer towards the end. Okay, thank you.
Thank you, Ethan. Okay, so so the topic today is selecting the right moving average. Now we all use moving averages, but how do we know which is the appropriate one? And once I'm able to identify an appropriate one, is it scalable across timeframes? Is it scalable across markets? So how do I determine that? How do I set that in a way that captures most of the price action? I'm not saying it can capture 100% because it's a, you're trying to apply a static model to a dynamic market. So there will be times when the moving average or the system may not work. But what our objective is that if you're able to identify something that captures most of the price action, then I think it could be a good starting point. So the way we've done this is that obviously once we are able to identify the moving average, we want to take that further and transform or translate translate that into a trading strategy. Why? Because having sporadic or having isolated models or systems wouldn't give us a sense of what's working and what's not working. But if you're able to have a seamless process right from identification of the strategy, identification of the moving average, transforming that into a strategy, and also identifying risk reward attractive risk reward opportunities in market. So that's the objective. Today we'll only look at the first part, which is identifying the average and how do we go about that process. Next Wednesday, we'll look at how do we use what we've set up today into a profitable or into a trading strategy that offers pretty good risk reward, both in any market conditions, scalable across timeframes also, and scalable across markets. But before we proceed, just again, just a reminder that this is just purely for educational purposes only. Something that I use myself, and I've used this over the years. I've explored, experimented over the years. So as Ethan mentioned, I'm trained economist, but then I finally moved on to price because that was something that I got very excited about. So I started with identifying these moving averages, systems, etc. Then I went on to code some of this. Then I went on to machine learning also, and identifying using machine learning to predict price and forecast price. So it's like all along, right from looking at charts and finally taking that into coding that into a strategy. So by all means, treat this as something like a one perspective, and treat this as something that you can take this forward into exploring on your own, see what's working not for you, what's not working for you. This is something that has worked for me because again, it depends on my risk profile, my investment, my trading horizon, etc. So depending on what suits you the best, have a look at it, play around with it, explore it, and see what comes out of this. So okay, so today's topics are largely, we start off with the very basic stuff in terms of why we use moving averages, what's the use of moving averages. Secondly, then we'll go on to, after we've identified that, we'll go on to identifying a process as to how do you set a moving average, and is there something like a golden moving average that can be used more or less for all markets? Because if we use different moving averages for different markets, and sometimes in a rush, and when sometimes markets are fast moving, we may tend to miss out on the ones that we have set for that particular market. So we want to minimize the time in terms of the effort in terms of analyzing at that particular point in time when the markets are on. So we want to do we want the system to tell us all these things. We just want to make that the decision making at that point in time, whether yes or no at that point in time. So the second part is we'll try to set an appropriate moving average or how to go about setting that. And finally, the first part of the foundation of identifying the right moving average and finally taking it to a convertible strategy. The first step of that is combining those averages, and the second and the third part we look at in next week presentation. So this will be the building blocks of the strategy that we look at next week. Okay, just before we proceed, just to get your sense, in your thoughts in terms of, do you really use moving averages in your trading or even market analysis? Just a simple yes or no, just so that I know, how involved or how familiar you are with moving averages. Oh, fantastic. Lovely. I don't even have to wait for 10 seconds. It's pretty much clear. So yeah, most of all are already using it. So from overwhelming, more than 2/3 or so, almost 75% are using moving average. So that's really, really very good. Now, the use of moving average can differ. So just one last poll before I don't think we've got any more polls, but just to get a sense, do you use it for support, resistance? Do you use for time trend identification, momentum purposes? Do you use it for trading setups? All of the above, or just one or two of these? Fantastic. It looks like more than half are using for all of the above. The truth is that yes, it can be used for all of the above. Whether it's support, resistance, whether it's trend identification, even momentum. How can we identify momentum just based on moving averages? I'm not talking about momentum based on an indicator, but I'm just saying, just by purely looking at moving averages, can we know what the momentum of the market is? So that's the second part. The third is trade setup, so which is what we'll discuss next week. Trade setup. How do we identify trade setup just purely based on momentum? How do we identify a risk reward? How do we identify a stop loss, an entry point? How do you set a target, both in terms of time target and also in terms of price target? So that's what our journey is going to be. So let's start off with the first part as to why we use moving average. What's the use? We can use, there are several other indicators. What's the advantage of using a moving average? Now, we all see price charts without any overlay, without any indicator overlaid on a price chart. If you're just purely using a price chart, it's just like akin to using unprocessed food. It doesn't tell us anything about the trend. We may have subjective interpretations of those trends. Okay, I think it's bullish, I think it's bearish, I think it's up, I think it's down. The problem with this is, the statement is that I think. It's a subjective assessment of what we think. So we want to minimize that subjectivity, and we want to have, as far as possible, de-biased assessment of what the trend is or what's going on in the market. I'm saying de-biased, I'm not saying unbiased, because the selection of these variables, the selection of the length of the moving average is to some extent subjective. So hence I'm saying a de-biased assessment, and it's not completely unbiased. But de-biased is still good enough, rather than using a biased assessment or I think kind of scenario. So moving averages help us to package or help us to process price data. So once I'm able to overlay a moving average, I get a sense of where the trend is. So for example, if the moving average is sloping upwards, I can say, yes, okay, the trend is up. Instead of I think the trend is up, I'm letting the indicator, I'm letting the average, moving average, tell us what the trend is. That's what we want to do. So it helps us segregate noise, and it helps us to identify or package price data to tell us what's going on in the market. Now, how do we know which moving average to select, or how do we know what an average will do. So an average will more or less take the recent set of numbers. It could be 5 days, this could be the last 10 days, it could be the last 15 days. And what it does is that it just extrapolates whatever date, whatever time frame we've selected, and gives us the reading for the next upcoming bar. So it's nothing but just using the past set of average. Could be we've learned in our school whether it's mean, mode, median, etc. So it just helps us to process that in a way so that we get an estimate of the most likely outcome in the next bar or the next few bars. But largely we tend to use it for the next 1 or 2 bars only, because price can change in the next 1 or 2 bars. So that's what the average will do. Then a moving average, taking that further, one step further in terms of a moving average. Why moving? Why not a static average? Well, if we use an average which is from 1950 onwards, S&P 500 to 2024, 75 years, it would hold little relevance because the price again is significantly different from what it was. So we want to use an average which is relevant to the most recent price conditions. So hence, we use an average which is more reflective of what's happened in the recent past rather than something which has happened a few decades ago. So a moving average will take, it's like a role applied to a set of data so that that role continues forward rather than remaining static. So that's essentially what a moving average is. Now, interestingly, the moving average will not only give us a sense of what the trend is, but we can also use to identify support resistance, as many of us already do. And also the next step is to take that into forward into identify a trading strategy. Now let's explore all these one by one and say, okay, what's coming out from these pointers. So firstly, as we saw earlier, that okay, let's look at this market condition. This was in, again, all the charts are dated, they are not current, so it's only again for information purposes only. So it's nothing to do with current charts, which has implications for what's happening in the near future. No, it's all dated charts. So this is, as we see, let me just take a pen, a highlighter. So here is the, sorry about that. Here we are. So this is, as we see, this is 2018. So it's a dated chart. Now let's see that we don't have any price, any indicator overlaid on this. And we all see, okay, the market is rising. Yes, we can see all that. It's nicely rising. Okay. And let's say we are at this point in time and the market has fallen so much. And it's really quite a sharp fall. We've not seen that sharp fall in the last, several months or so. This is the sharper fall. Why it's sharp fall? Because look at the length of the bars. The length of the bars tell us the extent of volatility going on in the market. So one thing is clear, that this is clearly it tells us that suddenly volatility has increased in the recent past. Okay, if it is increased in the recent past, the question now would arise is, okay, has the trend changed or is it still up? What is the trend? How do I make an assessment of what the trend is now? Should I be selling or should I be buying? So this will lead to some sort of subjectivity. I don't know what the trend is, or I can get a sense that yes, it's been up, but to put the current downfall in context of the bigger picture, I don't know whether it's a correction, we don't know whether it's a change of trend, or we don't know this is just a pause. So in such a case, what would happen is we can go forward and we can look at applying an average. An average, a moving average, will give us at least some sort of an assessment. So this is where we were in the previous slide. This bar was where we were in the previous slide. So now, if this is where we are in the previous slide, if we apply a moving average, and assuming that we had the bar, we closed the window, last window over here, if we had the moving average, then at least we know, okay, given the context of what the past price action has been, if we look at a slightly longer moving average, the trend is at least sloping upward. It gives us a sense that, okay, the trend is up. Even if we take a shorter moving average, it still suggests that the trend is up. So using purely moving averages, putting this drop into context, it suggests to us that it more or less could be a pause. Yes, it's correction. It could be a pause, but it doesn't mean that the trend has reversed. Why? Because the slope of both these averages has been up. So slope of the moving average tells us about the trend. And adding moving averages also debiases the assessment. It removes the emotions going on in that time. Oh, is it up? Is it down? What should I do? Etc. So these are some of the advantages as to why, how a moving average be useful to us. So as we saw earlier, that it represents a set of numbers that gives us a likely outcome. Okay, what does it mean? Now let's use the analogy of football, and my apologies if some of you are not football fans, but let's look at a very, very simple example, and let's take a footballer X is there. We won't want to name anybody, but let's say an ex footballer is there, and an ex footballer, and he has scored, say, 1 goal in the last 15 matches, and in the 15 matches prior to that, he didn't score any goals. So if I were to take an assessment, okay, in the last 15 matches, he scored 1 goal. If I have, and he's playing one tomorrow, and if I have to make an assessment, okay, what is the probability that he's going to score 1 goal tomorrow? So the most likely thing would be that, okay, since he scored 1 goal in the last 15 matches, it's more likely that he would score at least 1 goal in the next match. Now, had this question been answered, has this question been posed, say, 15 matches before, when you had scored 0 goals in the previous 15 matches, then the assessment would have been, okay, it doesn't look like he's going to score anything, because in the last 15 matches, he's not scored any goal. So what we would do, we were essentially using an average of what he's done. It's just 1 goal, that's why it comes to 1. But in a nutshell, what we can do is we can use the recent set of data. In this case, it is the 15 matches, but we can choose the last 5 matches. Assume in the last 5 matches, he scored 2 goals, and 15 matches before that, he scored 1 goal. So our assessment would be, okay, he's more likely to score 2 goals in the next match, because in the last 5 matches, he scored 2 goals. So what we're trying to do is trying to get an estimate of what the next outcome would be based on the average of the previous data, or average of the previous matches, or the average of the previous set of readings that we've had. Now we can take the same concept forward in markets, that, okay, if we want to attach greater importance to recent price action, say for example, volatility has gone up recently, say in the last 10 days, example only, hypothetical case, it's gone up in the 10 days, then I want to attach greater importance to the last 10 days price action. Then I would select a moving average, which is more replication, which is more reflects the recent price action. But if I'm saying I'm not a short-term trader, I'm more of a long-term, I'm not so concerned. I'm watchful, but I'm not so concerned in terms of my investment decision with regards to the last 10 days. Then I would say, okay, I don't want to have a moving average which is sensitive to the last 10 days. I want to have, say, a 1-year moving average. In that case, I'd select an appropriate moving average. So depending on how much importance I want to attach to the recent price action, I would go about selecting the average. Now, what does it mean then? So in this case, if we look at, say, a long-term investor, which is super long-term, 2000 day, I doubt whether anybody uses a 2000 day, but just to give an example in terms of how relevant it is. So if having a 2000 day moving average to an S&P 500 daily is meaningless, because it's of no use. It doesn't give us a sense of, say, support, resistance. Yes, it does give a sense of what the trend is, say, the last 10 years trend. Why? Because 200 trading days in a year, multiplied by 10 would be, say, last 10 years. So it gives us a sense of what the last 10 years price action is. But it may not be as relevant for someone who's having, say, a 2-week horizon, or a 1-month horizon, or even a 6-month horizon. So in that case, we may have to limit or lower down, or the choice of the selection of the time frame of the moving average. So moving average is nothing but a role applied to, whether it's a 200 day, 50 day. When I'm talking about 50 day, the role applied is 50 days. I'm looking at the last 50 days price action. I'm looking at the last 50 data points. It could be daily chart. It could be 50 bars in a hourly chart. It could be 50 bars in a 2-hourly chart. What I'm doing is I'm taking only the last 50 bars in coming up with this 50-day or a 50 period moving average. Likewise, it could be a 200-day, it could be a 10-day, it could be a 5-day. Now, moving average, as we saw in the previous slides, that it can be very useful also for support resistance. Now, in this case, it's 50 and 200-day. Now, normally, the most commonly ones are 21, 55, 100, 200. Why? Because these are happen to be also Fibonacci numbers, happen to be also 50 days, like a 3-month average, 21 days per 21 days, 22 days per month, 55 days is roughly 3 months, 100 days is roughly 6 months, and 200 days roughly 1 year. So there is no, it's not only the time frame, but also it's also related to Fibonacci numbers, which is it's like a golden set of numbers, which is very popular in financial markets. So could be a combination of Fibonacci numbers, or it could be a combination of the quarterly or the monthly market opening days. Okay, so in this case, let's look at how useful is a 50-day moving average. So as we can see that a 50-day moving average, more or less, I'm saying more or less, helps us to capture at least the pauses in an uptrend. I'm not saying the corrections, but a pause. More or less, we've seen what if this is going back to 2021. From 2021, we saw like 5 or 7 bouts of minor pullbacks, 2 to 5% pullbacks, and all those were contained around the 50-day moving average. Subsequently, we saw a big fall in 2022, and notice that it worked well also in capturing some of the rebounds. But if you want to capture a slightly longer, we want to capture a bigger correction, and we want to have, say, a 1-year time frame, we want to have a 1-year view of a trend in a particular market, then a 200-day is a very popular one. And 200-day, most of the times when that is broken, normally it does suggest that it's not just a pause that we've seen earlier, it is a correction that the market has set in. Now, there is also standard literature on how would you define a pause, how would you define a correction, how would you define a bear market. So normally, again, there is no set thumb of rule that this is what it is, but I would say a rough guideline that I've used in my trading journey is 2 to 5%, again in the context of US stock markets, again in the context of NASDAQ or S&P 500, would be like 2 to 5% would be roughly like a pause. Anything around 8 to 12% would be like a correction. Anything more than, say, 20% could be a reversal of a trend, or could be setting the stage of a bear market. Not necessarily a bear market, although newspaper headlines would normally suggest that 20% is a bear market, but that could be a stepping stone or a foundation for a bear market, but not necessarily one. So there are other things also that will go into that. So if you want to capture, say, a pause in a trend, then a 50-day can be a decent moving average that can capture that. If you want to capture corrections and maybe even reversals, then a 200-day could be something, or 200 period would be something which would be worthwhile exploring. Okay. Next, slope of a moving average can also give us an important cues about the trend. Now, we already saw that a rising slope, of course, is a sign of a rising market, and vice versa. But how can we get a sense of how strong that the trend is? So when you have a moving average which is gradually sloping, it suggests that the trend is up, and it's not a very strong trend, but it is an uptrend. Maybe it's an early stage of a bull market, could be also maybe a corrective rebound. We don't know what that is while it's unfolding in real time. But then we see that from this period onwards, we start to see the slopes improve slightly. The slope begins to improve slightly. Once the slope begins to improve slightly from what it was previously, it increases the odds that it's no longer just a corrective rebound. There could be more than that. This rally could have more legs. It could be indeed the the early stages of a bull market. When you start to see the slope of the moving average rise and rise exponentially like this is a hallmark that this trend is really strong and it's clearly in a bull market. Again, this is hindsight. Yes, looking in the rear view mirror to tell us that, because moving average is really an average of what the price action has been. But you are trying to use this in terms of a little bit of predictability in terms of how we can trade that. So it's not necessarily a leading indicator, it's more of a lagging indicator, but you can still use a lagging indicator to transform that into a strategy, which we'll see in the next in part 2 of this webinar. Okay, so the slope of a moving average can tell us also not only the trend but also the strength of that uptrend. This could be one way to identify the strength of an uptrend, which is the slope. Now, interesting thing is that in many cases, the reversal of that slope can also mean a change of trend. Notice in all this, the entire uptrend, we've seen that yes, there have been periods of pullback. The trend has flattened in some cases, but we've not seen the trend reverse until here. From here on, the trend actually goes, the slope actually turns negative. The slope actually begins to turn down, the moving average begins to turn down. So normally the change in slope in terms of rising, exponential rise, change in terms in slope in terms of, and change in terms of a reversal of a which is over. We have not used anything else so far, purely using moving average only to get a sense of what's really happening in the market. And again, to recap, it's because we want to have a de-biased assessment of what the trend is. Now, the question then comes up, which one to go for? Should we go for a shorter average or should we go for a longer moving average? So it has, again, it's a trade-off. So this is a 3-day moving average. A 3-day moving average is more or less replicates what the price is. We might as well not have, because it just becomes too sensitive to price. And it's very difficult to have a strategy on this time frame for the 3-day. We can go in a lower time frame to find out some strategy, but again, that would be a different time frame, a different risk reward, etc. So a very short moving average would hold little relevance. And a very long moving average like a 200-day, yes, it's not to say that it doesn't give us a sense of what the trend is. Yes, it does. But we want to come to a point where we can transform that into something which captures, say, 80-90% of the price, yet which is not too short, and yet which is not too long. So that's the idea, that how do we balance that in terms of getting the maximum out of the price, getting the maximum dips or pullbacks, and also not sacrificing the predictability, or not sacrificing the trend aspect or the trend element of that. So the first step into identifying an appropriate moving average would be, for any market, any time frame, we can start off with something in between a 5 to 10 year period moving average. A 5 to 10 period would be a pretty decent. The one that I use very extensively, and which is what I only use if I have 2 years shorter moving average, is the 10 period moving average. Throughout this presentation, we've used different markets, we've used different time frames, just to get a sense of the scalability of this moving average. I use the 10 period, hence I'm sharing that. You can by all means explore anything between the 5 to 10 period. Anything more than that would lose the relevance of the recent price action which you want to capture, if you're especially using it for trading purposes. Now 10 period, let's look at the 10 period. Now if we use a 10 period, notice more or less, I would say 75 to 80% of the dips were captured. All these dips were more or less captured by the 10-period moving average. Once the slope changed, the market also fell subsequently. Even in a downtrend, notice more or less, it will never be exact. But as long as we are able to capture 75-80% of the market condition, we are good enough. We're good over there. You will have periods, cases which are like this, where you have one or two bars which exceed that. But again, until what we saw earlier, until the slope reverses, until the slope changes, until the trend, until the moving average changes direction, until then, the trend of the market is unlikely to change. So in this case, the slope had not, it had become flat, but it didn't change, and hence it didn't last. But more or less, even in a downtrend, we are seeing that 70 to 80% we are able to capture that price action. Now, if this is a Euro USD daily chart, very similar, no change again, very similar. Notice all the smaller dips were easily captured in that. Likewise, whether it's a downtrend, whether it's an uptrend. So it's what this shows is that whether we use a daily chart or a weekly chart, this is a GBP weekly chart, even in regardless of the time frame we are using, or regardless of the market we are using, more or less the 10 period I found holds a very good. Now it wouldn't change much if you use a 9 period, or you wouldn't change much if you use 11 period. It wouldn't do much of a thing, but roughly around that is something that would be a starting point to begin this journey. Whether you look at a monthly chart, notice the monthly chart. See the monthly chart right from 2003 to 2000, late 2007. For 4 years or so, we didn't see a close below that 10 period moving average or 10-month median moving average. It didn't close. Only after in 2008 or so, it closed below, which is when the trend changed and we saw that big GFC fall coming in. After that, also notice the amount of dips that is captured. So whether it's a hourly chart or even higher time frame charts, whether it's stocks or commodities, look at the quarterly. In quarterly, since that GFC 2009, we've not seen a close below all along until this COVID sell-off that we saw. All along until then, we've not really seen much. Sorry, this was not the COVID. This was the Fed hiking episode. COVID sell-off was over here. So we've not really seen a close below that for, say, a multi-year period on a quarterly chart. So a 10 period also over here has worked remarkably well when it comes to setting up of the near-term moving average. Now, we got a sense of what the short-term moving average was, which captures the smaller dips. But what if we want to capture the slightly bigger, the corrections, so to say, also in that case? Then a higher multiple of that, a higher octave of that could be used. Normally, many people use, say, a 10 and a 20-day moving average, or a 10 and a 21-day moving average. Some use 21-day and 40-day moving average. I use a 10 period and a 30 period. And we'll very soon we'll see why it's not a 10 and 20, because 10 and 20, the difference turn out to be much. 10 and 30 captures different market conditions and different trend scenarios. Now, if we look at period, likewise, 30 period, just like the 10 period, also acted fairly well in capturing even the bigger corrections, which was the 2018 or the COVID sell-off was also on the monthly chart. S&P 500 also likewise applying on a weekly chart. Notice that it's captured even more pullbacks compared to what we saw in the 10 period. But again, because it's 30 period, it cannot capture everything, which is why we saw this, it didn't capture this big correction that came about, which was about roughly about 20% or so that came about. So yes, some part of it may have to be sacrificed, but as long as, how many times do we get that 20% plus sell-offs in history, like once in a few years or so? So broadly, as long as it is anything between 5 to 10% or so, roughly the 10 period and 30 period would capture it, and we can use that to identify favorable risk reward opportunities, which we'll see again in the next second part of this webinar. Okay, so taking again, this is another case. We started with quarterly, monthly, weekly, Aussie dollar, again, daily chart, 30 period also. More or less, it captures even more than what we saw. And notice, interestingly, that if it's anything, a drop below that means that at least for the subsequent few bars, this was like a the next 1 month trend or so changed. Until and unless the slope remains up, the trend was up. Again, slope changed to down, the trend was down. Once the slope started to change, the trend started to change. So sometimes it does give us not only a sense of the slope, the direction, but also support resistance. Again, this is a 4-hourly chart, 30 period applied to 4-hourly. Notice how well these dips right on that particular average itself, those whether it's a corrective pullback or whether it's a rebound in a bear market. Boiling it down to hourly charts also. This is gold, and look at the hourly charts. All these points, whether it's rebounds or whether it's dips, also more or less were unable to capture. But once that slope started to change, those resistance points became support points, and then the trend started changing from there on. This is still a dated chart. As you see, it's 1919 and gold is nowhere near 1919. So this is quite a dated chart. Now, the final part is, how do we combine this and what does it look like when you combine both the moving average? So when we combine both the moving averages with the 10 period and the 30 period, the smaller, as you see, captures the 2 to 5%, the smaller pauses, 2 to 5% pauses is the green line, 2 to 5%. But once you go more than that, once you go, say, higher single digit or just about lower double digits, 10, 12% correction or so, thereabout, then the green period comes into play. This is more than 10%, hence we saw even the red period changing. All these 8 to 10% very remarkably captured by both. So we are trying to capture not only the 2 to 5%, but we are also trying to capture the 8 to 10%. This is as far as NASDAQ. So in NASDAQ, this is a weekly chart. Likewise, whether it's a shorter correction, whether it's a slightly bigger correction, but again, notice once you started to see a close below the red moving average, which is the 30, the subsequent few weeks, the market kept selling or the market kept falling. So likewise, again, over here also, once the average was broken, you saw a subsequent few weeks, almost double of the decline that we saw earlier, which was replicated later on. So this is another indication of how we can use. But the beautiful thing about this is that we saw earlier that momentum of a market, the slope of a moving average, if it's a slightly flatter slope, it could be a nascent bull market, or it may be even a rebound in a corrective rebound in a bear market. Notice the slope started to pick up over here. Notice the slope was over here, was even stronger. It was even much sharper. So not only the slope of a trend gives you the strength of a trend, the gap between the two, the gap between the 10 and the 30 also gives an idea about the strength of a trend. The wider the gap, the stronger the trend is. And the beautiful part is, the wider the gap, even though you see the market falling below the red line, in most cases, I would say more than 60% of the times, the market will rebound. Why? Because the previous gap was just so huge. So whenever the market falls to this red line, which is the 30 period, and the gap is this wide, the chances of it just going down are very low. And that's the reason we can use this to turn into a strategy. Notice over here, see this, the gap was quite wide. Of course, in comparison to this gap is low, but we didn't have this price action when we were over here. In this scenario, the gap was looking as wide as this one. So what was the meaning? The meaning was the previous gap was so wide that any dip was not able to surpass the red line, especially when the slope was rising. This is a very important concept. Not only that the slope of the average gives us a sense of where the momentum is, but the gap between the 10 and the 30 period also gives us a sense of what the trend is. The wider the gap, the stronger the momentum. And the wider the gap, the less chance of the market breaking below that, at least in the first instance. So this was the first. So notice this was the first instance when the market fell to the red line. After that, there was no episode. This is the second instance. So when you have such a big gap between the 10 and 30, if the first time it falls, I would say most of the times the market will rebound from that, which is what the strategy is going to be when we look at it in the next webinar. So the first time at least, the risk reward tends to be very good in terms of playing along with the trend, along with this uptrend. More often than not, even the second time, because the gap is still wide, the market fell and then rebound. Only when both these slopes started to change, only when there was convergence of the two averages, that it was a warning sign that this trend is changing. Notice convergence of the trend, convergence of the two moving averages coming together was a sign that the trend is changing. The more they diverge, the more the gap increases, the stronger the trend. You can use any dips towards that red line for a strategy. Likewise, notice over here, this is Kiwi dollar, 4-hour chart. Notice the wider the gap, rest assured, in the first rebound at least, the market tends to respect that. Again, it's nothing is sure shot, but we are trying to identify probabilities. Why? Because analysis is nothing but an estimation of probabilities. If we can have a good sense of probability, okay, what the market is going to do, and please, we have not even overlaid any other indicator. We are only using moving averages to tell us what is the probability that the trend will continue, what is the probability that the trend will change from here on. This was the first time over here. Let me just get the laser pointer. This was the first time over here that after this deep dip, the market rebounded. What we saw earlier, that when the gap is wide between the two, when the first time it rebounds, the chances are it won't sustain. The chances are high that the trend will go. This is the second time it happened. Okay, now the trend, the moving averages have converged, but has the slope reversed of the red? No, it's not. It's flattened, but not reversed. Okay, good. Finally, the slope tends to reverse. Both the red and the green slope tends to reverse. It's now changed to up. If you just apply simple analysis, break off any resistance, no resistance was broken. No price pivot was broken. I'm saying price pivot. This was the first time a price pivot was broken. If you overlay a line over here, first time price pivot broken. First time slope of the moving, both the moving averages have changed. What does it tell us about the trend? That at least a warning sign, please do not go short in this market. It is telling us that the trend is changing. I need to switch tracks. I need to now switch gears, look at the market from the long side rather than the short side. Likewise, even on a daily chart, notice first time Hang Seng daily chart, notice the trend changed over here. Both slopes were up. Notice how fast the width between the two, the gap between the two widened. Why? Because it was almost a straight line rise. What did we see earlier? The first time after the crossover, the first time after the slope has reversed to up, the first dip when it falls, more or less the chances are that you will see a dip from there. You will see a rebound from there, which is what happened over here. Second time also happened the same. Why? Because the gap was still wide. Only when step one, the first moving average, the red line started to turn flat, but the red line was still up. Okay, good. The second warning signal, convergence of the moving average. Third was meeting point of the two averages. Fourth, both the slope reversed. At this point in time, you also saw a support break, which was not seen so far at all. No support break at all. Even this support was not broken over here. For the first time, a minor support was broken and the trend had changed. meant that this market has clearly sorry, changed trends. Likewise, Euro stocks, likewise weekly also, one can use it depending on what time horizon you are selecting. Again, on this also, I don't want to again repeat, but just to give you a sense, starting from from a crossover, when the gap is wide, for first dip to the red line is a good sign. After that, we saw a new rise. Again, gap was wide. Again, the market found support. After that, the trend clearly changed. There was convergence, is something like a wait and watch point. And again, we'll look at this, what the convergence means in terms of a trading strategy. We'll look at it again in the next time, that these are points where you should just wait and watch, and better to wait for some more cues before doing anything. Likewise, all the way over, the first rebound after the trend had changed, notice, not sustained. Why? Look at the gap. The gap just kept going on and on. When the market finds it difficult even to rise towards the red line, it is also a reflection of the trend, that how strong the downtrend is. Why? Because if the market has to reverse, it has to first go surpass the green line, go to the red line. Only after that is done, it can change tracks. The failure to go even towards the red line is another sign that the trend is clearly down. You don't need to analyze too much in terms of whether it's going to reverse soon or whether it's going to rebound soon. The rebound conditions can only happen once it even rises towards the red line. Why? If it does not showing any momentum even to rise towards the red line, forget about a reversal over the trend. For a reversal, you must, to go to the fourth floor, we need to go to four floor, level 2, level 3, and then level 4. But if the market is not able to rise above level 2, where is the question of it going to level 4? So hence, in this case, it could be another sign. Failure of a market to go to the red line is also a sign that the trend is even more stronger, i.e. the downtrend is even more stronger. Likewise, Dow monthly also very similar. And finally, even if you look at a smaller chart in terms of, this is Kiwi dollar in terms of the 4-hourly chart, notice I wanted to say that trend reversals are usually preceded, or more often than not, preceded by a crossover of moving. There was no crossover in a downtrend. The green line will be above the red line. In an uptrend, will be below you. One needs to be, at least at the very least, some sort of a crossover, some sort of a change of tracks, some sort of a change in slope of the two moving averages. This is again Hang Seng daily, likewise very similar to what we saw earlier. We've seen Euro stocks also, and finally Dow Jones moving average, which is the last slide, which is again trend reversals often preceded by a change in the slope. Just one final point before we open up for Q&A is to recap on what we've seen so far. We've seen how we can use the 10 period if you want to have something which captures the minor dips. If you want something to catch a slightly bigger correction, which is say 8 to 10%, or a longer, a slightly deeper pullback, then we can use a 30 period. Even in the case of 30 period, notice from 1986 on the monthly chart all the way till what, 200, 2000, for 14 years. This was just one instance where there was a close below, but we didn't see price follow through, which can be a suspect. There was no follow through close below for 14 years in Dow Jones moving average using the 30 period. So that was the second thing. The third thing that we saw is that the slope of the moving average can be a very good indicator of how the trend is evolving. Flatter the slope, the shallower the trend is. The steeper the slope, the stronger the trend is. We also looked at the gap between the two moving averages. The wider the gap, the stronger the trend. The narrower the gap, the less stronger the trend. The convergence of the gap is often a warning sign that the trend is changing. The crossover of these two averages is a sign that the trend has reversed. So these are few things that we saw in today's update. We will take this forward, that how do we capitalize this? How do we monetize this? Having a view on the market or having an assessment of the market is one thing, but to monetize that is something different. And what best it could be that we could use the analysis tools to translate that into a trading strategy instead of having something else in some other indicators to have a trading strategy. Doesn't mean that we don't have that. Yes, sure, we can have that also. But to have a seamless strategy right from identification of trading of a moving average all along up to exiting a trade, if we can have one seamless indicator, one seamless strategy, there's nothing like it. Then we don't need to look at other other strategies or other indicators. Again, it doesn't mean that we don't look at, but at least if one can help us, it can at least see us through and through. Okay, I'm going to stop sharing my screen, open it for any questions.
Okay.
Should you have? Very happy to take.
So let us look at the question box. Just give me 1 second. Okay, Manish, so maybe let's take the first question first. So I think there's a lot of clients and prospects are asking about whether the moving averages you use are those simple moving average or exponential.
Very good point. So in this case, I use the exponential moving average. Why exponential? Is because we want to attach greater importance to what's happened in the recent past. So a simple moving average will not be so much reflective. And I've tried using simple moving average also. I've tried different moving averages, but finally I went on to settle with exponential. These are all the charts that we've used so far today in today's presentation are all exponential. So it gives us a sense. If you overlay the same with simple moving averages, the result may not be as good. So I normally prefer, and I've again tried and tested with simple moving averages also. More often than not, exponential will capture better than a simple moving average.
Okay, so I think also primarily you may want to think about your intention. Exponential is usually more suitable for trading. If you're looking at longer term investing, then probably I think the simple moving average could be another way to look at the average price. Another question we have, how would you read across? So I think so this one has been answered in the last few slides, whereby I think Manish has shared that if the faster moving average crosses the slower one, which is the 10 crossing the 30, then that's simply indication of a trend reversal. Okay, let me see. Okay, so for equity, should one focus on daily moving average rather than the weekly one? So Manish, you want to take this one?
Correct. So again, as Ethan pointed out, that it really depends on the time frame that we're looking at. So for example, again, just I would say a rough estimate. I would not say it's a rule of thumb, but I would say if you have something like say a day trader or so, then something like an hourly chart could be a good again, this is not a rule, but I'm just saying an estimate. If I'm having, say, how I do it, if I want to get a sense of, and again I've back tested it also. So in my stints with Standard Chartered Bank, we came up with a my role was to come up with a model which was aligning with the asset allocation. So I had to come up with something which is give us a 1 month view, a 3 month view, and a 12-month view. And I had to decide, okay, which time frames should I select, and so that my back testing was done to give the average time frame of the back tested result should align with the asset allocation, just to get a sense of what the model is saying. Because again, we wanted to remove any biases from that asset allocation decision making process. My job was to come up with a technical side of price side of the entire investment strategy team. So for 1 month, I used to take something like a 240 4-hourly time frame was something that I found in my backtesting for a strategy was working fairly well. Again, that was more of a trend following strategy that I used. When I used a daily time frame, I used to get something like it turned out to be good for say a 3-month view. Again, I'm talking about an average. It could be something like anything between, say, maybe a 2-month to a 4-month able to go to a, say, a range kind of a thing. And to be able a 1 year view on an asset allocation, I use the weekly time frame. In terms of backtested risk, that was the range. So like 12 months or so could be a good way. So this is, again, I've backtested this on for my own system and for my own models that I've done in case if it's of use. But again, as I said, there is no rule of thumb. We just have to try and test it out. But this is clearly something that I've backtested.
Okay, so before we answer more questions, I just wanted to encourage everyone to also take 1 minute to just scan this QR code to leave us your feedback. So with this feedback, it helps us to know what kind of content you guys like. I think today's session has been really good, but if you could leave your feedback as well, we will know for our upcoming sessions, maybe we can structure around what kind of content the general audience or the main audience you would like to consume. And let's move on to the next question as well. Okay, so can we get the downloaded or recorded version of today's webinar? Okay, so yes, we will.
Sorry, I think we.
It's cut off, is it? Okay, yeah. So we.
Yes, Ethan, you're breaking off. But just recently, earlier you were fine.
Okay. So we will actually post this recording on our YouTube and IG Academy channel as well. So if you are keen to watch on demand or you want to share with a friend, that's fine as well. Okay, so it should be up by next week.
Correct.
So maybe let's see, maybe you can take about 2 more questions. So we have one that's asking on
sure.
the.
I just want to elaborate this one thing on. Yeah, Ethan, just one thing I wanted to elaborate on the point earlier. Now, in terms of what we saw earlier about the crossover of a moving average, we will be seeing this in terms of what to do when there is a crossover. Because, in real time, is it going to be continuation? Is it going to be, how do we play that? So we will look at the conditions when crossover will work, when crossover doesn't work, in terms of having a risk reward. What should we be doing in terms of action? That what should we be doing when there is a crossover taking place? What are the signs that we should look for when a crossover takes place? After a crossover takes place, what should we do? What are the additional things that we should look for before taking a stance on that or before taking action in that market? So to continue from on that question where Ethan left, that yes, we will be using at the crossover also when we look at the strategy next week.
Yeah. Okay, so let me see. When will the next session be? Okay, so the next session is actually same timing, 7 to 8 next Wednesday. Okay, so maybe we take the last question. Okay, so using 10 and 30 moving average is better than 50 and 200. Am I right to say that? Yeah.
It's not that. Like for example, there are some banks who sell side who use 50, 200 day. I know, someone who I've tracked very extensively, the last 20 years, and someone who's also is we exchange market views also, is Tom Fitzpatrick from Citibank based in New York, and I've been following him from last 20 years, and all along only he's done technicals for Citibank. He only uses 55 and 200 day. So that's his he's gotten used to that moving average. He's gotten used to that trend, and it fits his time frame, fits his relevance of the markets that he's looking at. There are some who use 3 moving averages, 10, 20, and 50. So depending on that. But to come back to the question as to 50 and 200 day, yes, 50 and 200 day can definitely be used, but provided I can also use the 200 day. But here, why we are using 10 and 30 is because we want to use this for our strategy. If we are using 50 and 200 day, can I use that to come to an action? Is what I'm saying. Having a view on just 50, 200 days, sure, I can. That's no problem at all. But the reason why we want to use 2 moving averages, which are relevant for a trading strategy, that's why we are using 10 and 30. But there's nothing stops us from using 50 and 200 day to get just a broader sense. Okay, 200 days like a 1 year. Okay, just to get a rough sense. Okay, the bigger picture. Sometimes, okay, good point also that sometimes we may be accustomed to say a 4 hourly time frame, say for our trading purposes, or maybe even an hourly time frame for our trading purposes. But once in a week, like what I do is normally Saturdays and Sundays or weekends is something that once in a while I do look at how the daily is looking, how the weekly is looking. Has the weekly picture changed in terms of the crossover of 10, 30? how is the monthly picture looking. If the quarterly is coming to an end, now the quarterly is coming to an end in the next few days. From Monday, Tuesday, I will look at how, or over the weekend, we'll look at how the quarterly has ended. So how the quarterly bar has changed. Is there a big reversal on that bar? Is there a small bar? Is there a doji, etc.? All these things. So once in a while on weekends, using these moving averages also on higher time frames as we saw earlier. So yes, whether we use 1030 on a 3-month moving on a monthly chart or a quarterly chart, or we use a 200-day moving average on a daily chart, it will more or less give us the same scenario.
Okay, thank you.
Sorry, I've overshot. Ethan, I've overshot the.
All good, all good. So I think we have one attendee is also asking about the recording for the next webinar. So to answer your question, yes, we'll be recording both sessions and uploading them on our IG Academy webinar library and our YouTube channel as well. So I think we have come to the end of the session today. I still see some questions asking about the different numbers. So there's 20, 50, there's 1030 versus 2050 and things like that. But I think maybe for our next session, Manish will be covering his trading setup and what is the number that he's using as well. So I think in the next session, if you are keen to learn more, you can ask more questions there as well. But today we have overrun by just a tiny bit. But I hope that you have found this session very valuable. I think this is also one of one of the better webinars that we have. It's a very high quality session, and I want to thank Manish for that. And if you enjoyed the session, please just leave a good feedback for Manish as well in the feedback form. And of course, we'll be ending the webinar soon. So I wish everyone a great end to your evening, and we'll see you next week. Okay. And to the viewers from other regions, please enjoy the rest of your day, and we'll see you again next week as well. All right. So thanks and goodbye, everyone.
Thank you, everybody. Thank you, Ethan, and thank you, and looking forward to seeing you all next week.
Thanks again, Manish. Cheers.